Welcome to Fiery Femmes, the podcast where high-achieving women build wealth, redesign their careers, and create lives with real freedom. I'm Sheena, an accredited investor, former tech sales professional, and the founder of Fiery Femmes. After a decade across global SaaS, startups, and my own reinventions, I realized the most powerful thing a woman can have is optionality. So, in every episode, we explore the future of work, the psychology of wealth, and the practical strategies that help women build careers and lives that evolve as fast as they do. Just a quick note before we begin, this podcast is for general information and educational purposes only. Nothing we discuss should be taken as financial, legal, or tax advice. We're sharing personal experiences and opinions, and everyone's situation is different. So always do your own research and speak with a licensed professional before making financial decisions. Brian, welcome to the podcast.
Thank you.
Really excited to have you here. A few of our audience have sent some questions as well. They're all excited. Obviously, I've known you from More and More Accounting. Can you tell us what you do there and how you've started your accounting career?
Cool. So more and more, I've been there for, it'll be 7 years as of about this week.
Your anniversary.
Exactly, yeah. So I started February, when was that, 2019 or something like that? Just fresh out of finishing university. It's gone quickly.
Good.
Yeah, exactly. I understand. I've got to say it's gone really, really, really quickly. I've picked up a lot of grey hairs throughout the years. But
okay, we can dive in.
Exactly. It ages me up, which is good in this sort of industry. But, look, basically everything, very client facing, half of my day these days is just spent on the phone talking to people, which I like. I'm a bit of a talker. The other half is basically managing staff. Yeah. And then developing systems and all that sort of stuff. It keeps you busy.
Yeah.
You know what I mean? So yeah, can't complain.
What led you to the accounting career path?
Good question. I never really wanted to be an accountant. It's not like I grew up as a young boy going I can't wait to crunch numbers.
I'd love to.
Yeah.
Can't wait.
I don't think anyone wakes up in the morning thinking that, well, particularly when you're a kid. It was effectively, I was at university and I've always been relatively extroverted. And I was actually thinking of doing a degree in marketing. University, the first year, it seems to be kind of like high school where you kind of have to have a bit of a taste of everything. And throughout the first year, I just ended up, I'd sit in these lecture halls and whatnot, and the lecturer would ask a question akin to what's 2 + 2? And everyone would be too shy to answer the question. I'd go, it's 4. Can we move on here type thing, which kind of led to me kind of developing relationships with some of these people. And they'd ask me, they go, Ryan, what are you going to do? I said, marketing. And just invariably, I had them say, don't do that. You seem like a pretty bright guy. Do accounting, economics, or finance. And at that point in my life, I didn't really know what I wanted to do anyway. So I basically just figured, all right, well, Dad's got an accounting business. I've got no idea what I want to do. And then I also just had this thing in the back of my mind that I wanted to do something entrepreneurial at some point in my life. I don't really like being told what to do. So I kind of viewed it through the lens of accounting is kind of the language of business. So if I get a really good understanding of that, it'll give me a fantastic foundation to effectively do anything.
Absolutely. And what I've noticed is most managing directors have a look at their background. They're accountants. That's their first career, and then they move up the ranks, but they become a managing director or CEO. But essentially, either they're in sales or they were an accountant.
Exactly. I actually have a lot of salespeople that were previously accountants as well. They reckon they have a better quality of life, and I probably tend to agree with them.
I agree.
Yeah, no, 100%. Look, one of the fantastic things of working in the industry that I do, and particularly the way that the business is structured, is I rub shoulders with everyone. You know what I mean? You've got people that are kind of struggling financially and not really happy with what they're doing. And then you've got people at the other end of the spectrum that have a fantastic quality of life, are able to amass significant, not fortunes, because typically they're going to be at, big fours and all that sort of stuff, but significantly wealthy people. And you just get to see what works and what doesn't. You know what I mean? So you get to see there's a lot of these, pattern recognition is one of the things I do relatively well. And just being able, over 7 years of intense experience, recognizing these patterns where it's well, if I do A, B seems to happen a lot of the time. So I think I'm going to start doing A. And then I guess one of those things as well where it's, it's kind of paying it forward type thing. Like I deal with some people in the industry and all that sort of stuff. And it's this attitude of effectively hiding knowledge
Yeah.
because it kind of gives you power and whatnot. Whereas I'm kind of the opinion that I do this for a living. I enjoy it. You're never going to keep up.
Yeah.
You know what I mean? Like if I explain something to you in terms of a complicated tax minimization strategy or how to structure your finance and you go do it yourself, congratulations, but you're probably going to need me in the future.
100%.
So I don't care. I'm just happy to get the information out there.
Yeah. And what I find as well is most people don't actually apply.
Like apply the information.
Yeah.
Yeah.
They'll ask you and you'll happily give the free information. They never apply it anyway. Yeah. It's very rare that they'll implement it, act on it. It's like, yeah, give away the information. It's totally fine.
Well, I mean, that's a lot of the time it's easier said than done. And it seems like these days everyone has such busy lives that it's difficult. Like even myself, like I have all this information. I've just turned 30 probably 6 months ago, but I've had a lot of this information for 4, 5, 6 years and just starting to apply it in the last 2 years or so. I can see the difference 100%. So not giving anyone financial advice or anything like that, but I feel like, you know, going back to brass tax principles and whatnot.
What does that mean, brass tax principles?
Just getting down to the grassroots of the matter at hand, what works and what doesn't, rather than it's like most things, like the things that really work typically are kind of simple. It gets complicated as well, but yeah, I just feel like one of the things that I notice is you got to spend a lot of time up front with most things that are going to have a really significant ROI, whether it doesn't have to be just financial, it's health, it's everything in life. You spend that time up front where you can't really see the fruits of your labor and get a solid structure in place. Everything rolls on from there. You know what I mean? So it's just spend the time. Like if we're talking about your financial life, having a look at your budget. If you got a mortgage, how are we going to pay down the mortgage quicker, et cetera, get a good plan in place and then just run it. And then you're reviewing on a periodic basis. People don't have time. Like some people do. I know people that are checking their stock portfolios every day and all that sort of stuff. I don't have the time for it. I don't think it's a good way, but it depends. If you're a high frequency trader, you need to do that, right? But most people set a structure in place and then you're reviewing maybe on a monthly, 3-monthly basis type thing.
Nice. Ryan, I want to go back a few sentences or conversations before. You mentioned that you have had the privilege to see what successful people do and like you've seen the pattern or you've recognized the patterns that they do.
Sure.
For our audience, can you, I guess, like share with us what the top earners or even top performers or maybe even the happiest clients do?
It kind of depends on who we're talking about, to be honest, because I'd imagine a significant portion of your listeners and whatnot, they're probably employed. And there's different rules for the employed as opposed to the self-employed business operators. I deal with a lot of business operators, and that's people that are really focused on patterns. If we're just going overarching, I would say people that, you know, without sounding cheesy, just kind of pay it forward. Going back to what we said before, I find that people that bring a lot of energy to life and they're happy it's providing value. You know what I mean? At the end of the day, I feel like most things that you're going to get money for, you're solving people's problems in some way or another. And if you're willing to go that step beyond where people know that you're taking care of them, everything else will take care of itself. So that's like brass principles I see just generally with people. When it comes to people operating businesses, what I find is a lot of people, they go from basically being on wages to being self-employed and running, let's say through a company structure or something to that effect. And they've kind of had their employer withholding tax throughout their career, not having to worry about managing their own taxes, as opposed to moving into a business structure where you're now responsible for everything. And the issue is a lot of people don't have this sort of knowledge and the foresight to go, well, let's say you're doing pretty well and you just picked up a short-term contract over a 3-month period and 100K's hit the bank in the company account, not appreciating that legal separation between the company and you as an individual. And they go, well, I've got no overheads. It's basically just me. I'm rich. I've got $100,000 at my disposal. I'm just going to go ahead and live a frivolous lifestyle and all that sort of stuff. Not taking into consideration that, well, if you're taking that money out of the company, you're now at the behest of the marginal rate taxation system, as opposed to keeping it in the company. So you asked me before, basically, what are the principles? What have I seen work? Overall, provide value, go above and beyond. It always gets paid back to you in multitude. When it comes to running your own business, obviously having a solid plan in place, you'd be silly to do otherwise. But people that keep the money in their company bank account tend to do very well. And I would suggest that it goes back to a difference in their perspective and their view on things. They live kind of within their means, they're relatively frugal, and keeping that money in the company bank account as opposed to pulling it out and so you're doing really well. Well, now I might be paying 47 cents in the dollar tax, right? Whereas if I keep it in the company, you're going to be paying at small business entity tax rate 25 cents in the dollar. There's a 22% tax saving there.
Yep.
You know what I mean? So if you allow that to compound 2, 3, 4 years, you look up, you've been taking a wage that you require to live. And then you've got basically the kitty growing slowly but surely within the company account. You look up in 4 or 5 years, you might have $500,000 sitting there. And then the world's your oyster. You've got capital deployed for growing the business, expanding the business, taking on more people. And obviously you're considering this throughout the period as well, right? But with stuff like that, or potentially, for instance, an interesting structure is building up money within that account, and then you can loan it from your own company to go acquire a property or something to that effect. And you can actually negatively gear your property as well as with a bank loan with your own company. That's something that, we've worked with people with, and it's a useful strategy, as I'm sure you can imagine.
I can imagine. Actually, that's pretty nifty. Would you say, because you mentioned earlier about like having the capital grow and just making sure that it's in the company bank account. I would also, for those who's listening, who's thinking of like having a business, opening a business structure,
Sure.
make sure that you have multiple accounts, right? One for like taxes.
Yeah.
So every time that you do get paid, just set that aside.
Yeah.
How much percent, if you're a business owner?
Yeah, it depends. And look, even in terms of the multiple accounts, you don't have to. It's just advisable for most people, particularly when you're getting started. Again, you see that money in the account and you're not provisioning for your upcoming taxes. And then you've kind of got that temptation there of, oh, well, maybe a holiday around the world for 6 months could be fun. I've got the money sitting there anyway, right? Not that you'd be doing if you're starting out as a business owner, but just an example. The multiple accounts typically, look, 2 in particular, for me now, I've probably got, let's say 4. So the examples would be, you got your normal operating account. So you've got your income coming in, your expenses. You want to make it simple from a business administration standpoint, whereby you get some people, they're just transitioning over to a company account and maybe they don't have enough money in the company account at that time and they start paying for business expenses out of their personal account. You can do it. It just makes it more complicated and the likelihood that something's missed goes up. So you quarantine, you keep all the business transactions operational from an operational perspective within that operating account. You then want to be basically doing some sort of allocation into a tax savings account, I would suggest. And you can slice it up however it really works for you, just so long as you're aware that, hey, that BAS is coming up in 3 months' time. And roughly speaking, you probably got a payroll system in place. And most people, they're starting out, they might have 1 to maybe 5 employees. It's pretty easy to project, hey, this is what I'm going to need to cover my withholding liabilities in 3 months' time. So that's taken care of. And then it depends on your industry from a GST perspective. So GST is 1/11 of the gross sales that are hitting your account. So that's the sales component. And then you've got GST on your purchases, which can vary wildly depending on what your outgoings are. So a lot of people, they might have high expenses, but it might be just labor, for instance, wages, where you don't have GST credits on that. So withholding, pretty simple. You should probably have a formal payroll system set up. Easy to project. GST, if you want to cover yourself, just 1/11 of your sales. That'll cover most of it. And then once you've gone through your first year of trading, hopefully you've made a profit, you're going to pay company tax. Now, what the ATO does, because particularly if you're going through a tax agent, let's say the financial year ends on the 30th of June, 2026. Well, that company tax payable actually isn't due till May the following year, right?
Yeah.
So, and a lot of people, like I work with clients and you delay because potentially you lodge it earlier, payment due dates. So
not May anymore?
It is May. You have to lodge and pay by May. But if you lodge, let's say 30th of June financial year finishes, and then you lodge your tax return on the 31st of October, let's say, what they'll do in practice commonly is like, oh, okay, well, we want you to pay by the 31st of December, or we want you to pay by the end of February. So potentially can buy you a little bit of extra time to pay that company tax. But going back to my original point, you got GST, you got withholding, And then you got PAYG installments. So the ATO effectively go, okay, you made $80,000 in net profit last year. You had to pay us $20,000 in tax. Moving forward, we want you paying $5,000 per quarter. So basically at the end of the financial year, you're covered for the most part.
Yeah.
And there might be a bit of a variation. Maybe you made more money, maybe you made less. There's going to be less of a shortfall. The reason they're doing that is one, the ATO, think of them almost like a business in themselves. They want their money now, not later, like everyone, right?
Yeah.
And then second to that, going back to the discipline with everything, people might have a really good year. And unless they got that almost like forced tax saving sort of thing in place with the ATO, they get to the end of the year and they go, well, I owe 20K, the money's gone. And then all of a sudden you're on ATO payment programs and all that sort of stuff, which the ATO are massive on, and it's quite costly for your business as well.
I heard the last time I heard about it, it's about 8% in interest.
11%,
now
I
it's
believe.
11?
Yeah,
Okay.
I believe it's 11% annualized. And the real kicker is up until this point, ATO general interest charges, GIC is referred to as, they were tax deductible. As of the 1st of July 25 onwards, no longer tax deductible.
What?
Yeah, exactly. So maybe when you're saying the 8%, you've almost kind of cut through the quick there in terms of that's the after tax cost of the interest.
Yeah.
Well, now you can't claim as a tax deduction. So your business is bearing the full load of that 11%. It's more expensive than a bank.
Yeah,
And
100%.
I've had discussions with the ATO, and they've effectively said, like, Ryan, we're not a bank. We're not giving out interest-free loans to people. So you just need to be, very mindful. And it's good for you anyway, because at the end of the day, we live in a fantastic country as far as I'm concerned.
We do.
I think 47% on the dollar is a bit heavy. But we should be paying tax. And at the end of the day, like, I get people that come to me, it's like, I don't want to pay any tax. It's like, well, go live in Panama or something. No, that's not how our tax system works. If you're running a successful business, you should be paying tax, and it's not a massive deal anyway.
Yeah.
Like if you're able to, through effective tax planning, depending on how much income you're earning and what investments you want to get involved with and how you want them structured, you can typically have like in my experience, an aggregated sort of tax rate across the group between the individual and the trading entity of about 25 to 30 cents on the dollar on average. I think that's a reasonable price to pay when you're earning pretty good money and you live in a beautiful country. So it is what it is.
Yeah, definitely. And I think you can definitely see as well. I think one of the good things about Australia is you can actually see where the tax dollars are going. We can go to the beach for free. In some places that have beautiful beaches, like in the Philippines, you have to pay for the beaches.
Really?
Yeah.
I've been in the Philippines. I don't even remember that, to be honest.
Did you go with a guide?
No.
You just went?
Yeah. But there's probably certain areas, like we went Boracay, Boracay, and where else did we go? We went to Palawan.
Yeah.
Yeah, beautiful country, by the way.
Basically, whenever we go, maybe like Boracay and Palawan, because it's such a touristy place, they've done some arrangement with hotels and whatnot. And in the Philippines, basically, there would be places where we'll go there for the day, but we have to pay like 25 pesos. Plus, if you want to use one of those huts, it's another like
Kocha.
right.
Yeah.
So when we moved to Australia and like the beaches are so clean, you don't have to. What do you mean? There's no entrance fee? That's weird.
100%. Yeah. And look, again, 47 cents the dollar, in my opinion, is a little bit heavy. Particularly, and that's the thing. I mean, we're talking about everything, tax and et cetera, et cetera. And when you're an employee, you're pretty limited as to how you go about minimizing your tax. You can't manage it across your business structure and all that sort of stuff. If you're on 500K a year, you're somewhat locked in. Basically, where people go about minimizing their tax is through their investments and whatnot. So just to quickly touch on that, I suppose, there's this massive thing about negative gearing. It's a great strategy, don't get me wrong, and I utilize it myself, right? But it's overblown and commonly misunderstood as well. So
agreed.
One of the biggest things with negative gearing is at the end, the way the lens that you need to view negative gearing is, you're effectively getting short-term benefit and long-term gain, hopefully. So for instance, let's say you're using negative gearing as a strategy in property. Right? Most common. All that means is effectively your outgoings are outweighing your ingoings, right? So you got a cash flow issue there potentially. Where it can get a little bit more attractive is depreciation for the most part. Yeah. So depreciation, obviously, typically you're talking about capital works, which is cooked in with the actual purchase price of the property, whatever it is.
Did you say capital works?
Capital works deductions. So you've got two different forms of depreciation with regards to properties. You've got capital allowances. That's your white goods and your property, blinds, stuff like that, where they've got a set effective life of, typically up to about 10, maximum 20 years type thing. So let's say you go buy a dishwasher. Let's say it's got an effective life of 10 years, it's $1,000. Congratulations, you've got $100 a year tax deduction. It's only so far you can go with it, right?
Yeah.
On the flip side of the coin, you've got capital works. So capital works are effectively depreciation for the building and structural improvements themselves. So let's say it's any point within the last 40 years, but let's say it's a relatively new build. It's like, let's say $400,000. You got a $10,000 a year tax deduction for that.
Okay. Wow.
Yeah. So it's the calculation is 400,000 divided by 40, 10,000, and then times that by your marginal rate. So let's say your highest marginal rate, it's like $4,700 a year tax reduction by virtue of that depreciation.
That's pretty good.
It's great. But at the end of the day, focusing just on tax, this is coming from a tax accountant. I feel like
Listen up, guys.
It's almost a loser's game. You want to minimize your tax where possible, but I always tell clients making money is the most important thing. Tax is the biggest expense you've effectively got, right? Particularly as a high income earner.
Yeah.
But it's second to earning money itself. So going back to negative gearing. Negative gearing is effectively your expenses from a tax deductible perspective outweighing the income that's coming in.
Yeah.
And then effectively that differential, so let's say it's $20,000 worth of income with $40,000 worth of expenses. We've now got a tax deduction of $20,000. Think of it as a government subsidization where they go, well, you're effectively boosting up the housing market. Potentially, this is their thinking.
That's my theory as well.
Yeah.
I'm like, okay.
You're boosting up the housing market. You've incurred additional expenses that have outweighed your income of $20K. Claims a tax deduction in that example that it'd save you like $9,000, whatever it is, right? If that's all that's going on and you've bought a horrible property, that's a bad strategy.
Yeah.
You know what I mean?
100%.
So when you're looking at negative gearing, the lens that I look at it through is, does my after-tax cost of holding the asset, does the capital growth outweigh the after-tax cost of holding the asset? If the answer is yes, that's great. You've made a good decision. If the answer is no, you got an issue.
Is that calculated through the year? So for example, because property is such a long game, right? So for example, you bought a property, grew like last 12 months, 100,000, but your expenses would be like, including all the mortgage repayments, interest, all the expenses, okay?
Yeah.
Would that still be a bad decision? But that's...
No, it's not. That's exactly what I'm referring to. So that's effectively the beauty of it. So you're getting that tax reduction and that's an expense that you're going to be incurring regardless, right? So let's minimize that. What you're not recognizing at this point is the capital growth. That's not realized until you obviously sell the property, right? But that's a perfect example, Sheena. So you're looking at, let's say the property's gone up $100,000. You're at a good property there, right? $100,000 and the after-tax cost. So what I'm referring to there is income less tax deductible expenses. You're not including your principal in this in this calculation. Okay. Because the way that I view principal is effectively, it's like a forced saving mechanism. You're building
equity. This is such an accountant thing, by the way.
Yeah, maybe I'm getting too technical.
No. You're the second accountant who mentioned forced savings on property.
Gotcha.
Yeah.
Cool. That's effectively what principal is.
I love it.
So it's a forced saving mechanism there. So you're disregarding the capital component of it. What you're looking at is income, less all your other outgoings. Don't even worry about your repayments yet. And then the interest, right? That's basically where your net profit or whatever you want to call it within the business within the property is. And then you've got cash flow on top of that. Because obviously principal does affect your cash flow. So for instance, I've looked at a property recently myself, and by structuring it a way where I can add decent deposit, hopefully, and then you've got the projected income coming in, less all my outgoings, including the principal, it costs me about $160 per week. That's everything. Okay. Right. So I've got the forced saving mechanism in there. That's after the negative gearing's already been claimed. It cost me $160 per week. Right. Yeah. That's in cash flow. So one other thing that we'll touch on that I think is worth touching on with regards to negative gearing and whatnot, you got something called a PAYG withholding variation. This is where it comes back into your cash flow. So I'll be doing one.
Let's just say PAYG is when you're an employee, right?
Precisely. Yeah,
Yeah.
exactly. And even if you're running your own business, I'd imagine that typically you're going to be paying yourself a wage anyway, right? Or if you're an ABN contractor, that's a different story. But PAYG withholding with regards to negative gearing, where you've got more outgoings from a tax deductible tax perspective than incomings, you're effectively assisting your cash flow there. So let's say, going back to that example before, we got $20,000 worth of income, we got $40,000 worth of tax deductions in the property. I now have a $20,000 tax deduction that's going to offset my other forms of taxable income.
Yeah.
Yeah. I get 47 cents of the dollar real money, cash savings, tax savings, cash from that 20K. So call it 9K, right? I then put in a PAYG withholding variation with the ATO that informs my employer. What that's going to do is boost up my net payments in my wage throughout the entirety of the financial year, as opposed to having to wait until the end of the financial year.
Oh, yeah. So you don't have to do to lodge your tax
return and get a refund from the tax department. You effectively, it's almost like doing a P&L and sending it through the tax department. You go, well, look, this is my situation. This is what we're anticipating with regards to the loss at the end of the year. I want my money throughout the financial year. Yeah. So let's say, for the same example, let's say you get paid on a monthly basis, and the tax effect at the end of the day from the negative gearing is $12,000. You're going to get a $12,000 refund at the end of the year. PAYG withholding variation goes in. Let's say you're paid on a monthly basis. You have an extra $1,000 paid to you throughout the year. Wow. Obviously, where that becomes very beneficial is when you've got investments that have debt with them and all that sort of stuff. So let's say a typical example, you've got principal place of residence and an investment property. You're able to allow that money that's spitting out from the investment property by virtue of, it could be just the negative gearing. It might even be slightly cash flow positive, but tax negative, right?
Yeah.
You take that money, pay down the non-deductible debt on your main residence, because it's a very big thing within tax finance, all that sort of stuff. Structuring your debt to ensure that you're minimizing and paying down as quickly as possible your non-deductible debt, as opposed to deductible debt.
So wait, let's just repeat that. So we want to make sure that we're paying down the non-deductible debt first versus the deductible debt.
Precisely.
So your PPR, or like your place of residence.
Precisely. Exactly. Yeah. Reason being is you're effectively getting a tax subsidization of your tax deductible debt, your investment debt. Yeah. If it's producing income. So let's say you have $100,000 worth of interest on your principal place of residence per year. You got $100,000 worth of interest on an investment property. If you got $200,000 worth of interest per annum, you're on a high income. You're paying 47 cents on the dollar. Dollar for dollar interest on the 100K, $1,000 after tax cost on the deductible interest. I want to pay down the one that's more expensive for me, right? And then keep that one in place if I've got the choice between the two. That's all it is.
See. And would love to get your thoughts and obviously your opinion on this. There's a lot of push on like rent vesting. Obviously, the strategy that we talked about earlier was having your principal place of residence, and then having an investment property, which is very, very popular. And these days, there are a lot of people talking about rent vesting.
Sure.
What are your thoughts on that?
It can be a fantastic strategy. It really depends on the circumstances that the individuals we're talking about, right? So rent vesting I see commonly utilized where you've got people around our age that might not have a family and children and all that sort of stuff at this point, right? So, because like we spoke about before, it's not just about money. I speak to people all the time and I'll crunch the numbers and I go, well, look, you rent vest, it's going to put an extra $15,000, $20,000 a year in your pocket to enable you to pay down your debt, blah, 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 whatever you want to do with it. And they go, well, Ryan, that's great, but I got a wife and kids. You know what I mean? And the moves that I need to make to put this in place, it's just not worth it for me at this point. But rent vesting, let's say, for instance, myself, you're 30 years old, single, no children. There's two main things that you're looking to take advantage for with regards to rent vesting. First and foremost is you're effectively arbitraging the difference between the cash inflow that you could, so arbitraging is effectively taking advantage of the difference between the two. Taking advantage of the difference between the two. So for instance, let's say I got a property, I've acquired it recently, and that property could generate me $1,000 worth of income per week. I'm young, I'm single, I'm happy to live with my mate, and I could be paying $500 a week and living in a really nice place just with a roommate. where you've got an additional $500 per week worth of addition. You're going to be incurring all the other expenses that go along with holding a property anyway, your strata, your council, what have you, right? So if I can get more money in than I'm paying out, well, I'm happy. In that example, $1,000 per week I'm renting it out for. I'm renting. So you're looking at, I'm incurring my interest expenses, the depreciation claims there sitting out there in the ether. I can't, if it's my main place of residence, which the cash inflow plus outflow, plus take advantage of the tax savings by virtue of negative gearing, I'm going to be in a better financial position typically. And then it's beautiful, the stuff that you can do with that additional money.
Yeah.
Pay down the loan quicker. You know what I mean? So yeah, it's a useful strategy for sure, but it depends on the person's circumstances.
Yeah, absolutely. I also feel, and this is my bias probably because it's the strategy that I've implemented, but it's also good to kind of, you don't know what you don't know. And I think like when holding property, people don't really know about like potential expenses, don't know about retaining wall stuff, or just things to like watch out for. So
read your strata plan reports before you go buying property. It's very important.
yeah.
Yeah, 100%. And there's other, like that. I could sit here all day and talk about the advantages and I love property.
Yeah.
My whole family's property mad, right? Like, so for instance, I get a lot of clients and it's like, oh, I want to go buy this just brand new development because it's got really big depreciation claims. That can be great, but you need, typically and you want to speak to property experts about this sort of stuff. But in my experience, typically there's a lag time.
Huge.
Yeah.
Like
you're talking
multiple years
3 to 5 years, right?
Yeah.
So you better hope that it's a long-term investment. One thing that popped to mind, that popped out before when we're discussing everything else, is appropriately leveraging the main residence exemption.
What do you mean by that?
So you've got you're aware of the main residence exemption?
No.
So the main residence exemption is effectively when you acquire a property, you live in it, it's your main residence. You don't pay any capital gains tax on the capital growth of that property. That's the main residence exemption. The beauty of it is you've also got something called the absence rule. So the absence rule means if I establish a property as my main residence and make sure that you get all the appropriate documentation to substantiate the fact that I live there, updating the electoral roll, proof that your driver's license was updated, some moving invoices is great, all that sort of, I lived there. You can then move out of the property and rent it out for a subsequent period of 6 years and maintain that full main residence exemption.
Right.
So the beauty of that is, remember I said before, you want the capital growth to outweigh the after-tax cost of holding the asset?
Yeah.
Well, I've acquired the property. I move into it. And you've got stamp duty exemptions and all that sort of stuff. As I said, I could talk all day.
Yeah.
You move into the property, establish your main residence. You then move out. You're unlocking the benefits of rent vesting.
Yeah.
Cash inflow in versus expenses out, negative gearing. Great. So now I'm supercharging my repayments. I've got a PAYG withholding variation in place. I'm paying down my loan quicker on a monthly basis or a weekly, whatever I can do, because obviously interest is calculated daily, typically charged monthly. The more money I can get into my offset account or into the loan, the less interest I'm going to pay.
Yeah.
The less interest I'm going to pay, my repayments are the same, the more equity I'm building within the property.
Yeah.
So I'm supercharging that by rent vesting.
That 6 years.
Yeah.
What happens on the 6th year?
You can sell the property.
Yeah.
No capital gains tax.
What if you don't want to sell the property?
You got 2 options.
Yeah.
Move back into the property.
Yeah.
Reestablish as your main residence again. Move back out for another 6 years, called bunny hopping. Or you sell it.
The strategy that I did that for, it's actually the 6th year now, and I totally forgot.
There you go.
Oh my God. Oh, I'll make a meeting. Oh my God. Okay. I totally, I think, when was the settlement? September, I think.
You're looking on, no, exactly. When you moved in. So it's the point in which you moved in and moved out. That's what you're calculating everything, all this sort of stuff on.
I see.
So you can then move back into the property, reestablish your main residence, and then move back out. You can sell it, or from that point onwards, you get typically what you would do is you get a valuer out, and you go, well, at the end of the 6 years, it's gone from being worth $1 million to $2 million, and then from that point onwards, you're up for CGT. So let's say you sell it another 6 years' time and it's gone up another $1 million, right? We're talking about a crazy good property here, but anyway.
Pretty good.
Yeah, that's good investment, right?
Yes, that's why I don't want to sell it now.
So let's say it's gone for $1 million and in 6 years it's gone to $2 million. And then at that point, you're basically up for CGT because you're like, oh, I bought something else or whatever. I don't want to move in. You then hold on to it for another 6 years. Well, the difference between the $2 million and the subsequent sale price at the end of the day that's where you're paying capital gains tax on. And another benefit, obviously, it's a point of contention at the moment with the government,
Yeah, I saw
the
the
50% CGT discount as well. So even if you're on the highest marginal rate, you can just stack strategy on top of strategy on top of strategy. And, the idea is obviously you're accruing wealth.
Yeah,
You need a
right.
financial planner for some of this stuff purely from a taxation point of view.
Mm-hmm.
Yeah, that's one of the strategies. And you can see it's multiple things on top of one another.
Yeah. Okay. Perfect. No, that's super insightful. I know like a lot of people who one of the main things is they're earning pretty decent money. They're also getting different forms of compensation from whether it's like the stocks, options,
Sure.
whatnot. And then thinking about different ways to offset tax or just making their money work for them as well.
Sure.
So there's property and obviously there's shares as well. What are the other common things that you see for high income earners?
In terms of what they put their money into or how they minimize their tax, or
I would say how they make their money work for them.
I mean, it depends on how much money they've got. But look, they're the two most common ones.
Mhm.
It's going to be either shares or most commonly property.
Yeah.
Some people are super risk adverse, or a lot of people that they're really high incomes, they just don't have the time. And they're like, I'm making so much money, like they don't know what to do with it. So they just put in a term deposit. Or I've seen people that have way too much money sitting in an account that's not even accruing interest. So not only is it not a term deposit or something, it's not even an interest-bearing account, which I mean is just, it's crazy to me, but to each their own. But yeah, they're the most common for sure. Property, shares, and it depends, a lot of people then go, once they get to a certain level, they don't have the interest all the time. They just engage a financial planner. Financial planner is probably a disclosure, not a disclosure, but something to be mindful. Typically, the setup fees for getting a structure in place with a financial planner, not tax deductible. There's a principle called at a point too soon within tax law that effectively means if you incur a cost, but you're not yet producing income from whatever you're doing, it's not deductible. So first year of a financial plan, for the most part, it's not going to be deductible. But then the subsequent reviews each financial year, once you're generating income, they will be tax deductible. Be careful. Financial planning advice space it can be a minefield, I've seen.
Yeah.
But they can be incredibly useful, particularly if you've got the money to justify a financial planner. You know what I mean? Like if you don't have enough money tucked away, it might be useful to go, see a financial plan for a budget, a bit of an outline of a plan. But you got $50K and you're paying someone $2,000-$3,000 a year to invest your money with the brokerage fees and a lot of the time, the cost benefit's not really there. So so to go back to your original question, pretty stocks, going to see financial planners to get advice from them, and then they obviously invest your money from there. Or people that they don't have the time, they haven't thought about it. It's just sitting in an account somewhere.
I've with the fiery fans, I've interviewed a lot of people who definitely make bank and makes great amount of money, but because they're so focused on the work and like making that amount of money, they're taking the time to understand like investing or even practice that muscle of investing or knowing what they can claim, why you should go to a high interest savings account at the very least. You just don't have the time.
I get it. Everyone's so busy, but it's spending that time up front, getting a structure in place where you don't have to think about it. And you'll look up in 5 years' time and go, thank God I did that.
Yeah.
You're really busy, set up automatic, like I do this myself with savings and whatnot. I've got 2 or 3 automatic transfers set up per week, going into a savings account, going into like a little fun account, going into my offset account. So spend the time, figure out your goals and all that sort of stuff, and then set up a structure where you don't have to spend much time on it. And you will thank yourself down the line, 100%. Another thing that I see far too common, you got to be careful here, but if you're a really, really high income earner and you're on wages and you've got a spouse that's not on high income and you've got a lot of money in the bank, you're paying 47 cents the dollar at any subsequent interest income that you earn. So let's say you've got $1 million in the bank and you're earning 5% per annum, it's $50K worth of interest. Yeah. You're on $500K. That $50,000 interest, half of it's going to the tax man. Yeah. Whereas if you've got a partner, potentially a stay-at-home partner or something to that effect that's not earning any income, potentially it may make sense. And obviously you've got marital breakdowns and all that sort of stuff, legal considerations, world considerations. From a taxation point of view, you put down your partner's name, you're paying $5,000 tax on that interest income, as opposed to
Yeah.
Exactly. 25 on the 50. Exactly.
I've heard people of like, I don't know whether this is too complicated for, I guess, like that situation, but I've heard of people creating a trust
Mhm.
and doing that.
Yeah, you can do all this sort of stuff. It's just cost benefit.
Yeah.
So one of the common things that I see because we're a suburban practice operating out of Bondi Junction. We inherit these clients where maybe they're doing a consultancy business turning over $200,000 to $300,000 per annum, and they've got 6 entities in the group. That's why. That's
Yeah.
like I'm looking at it and I get the structure diagram and I go like the only thing that I can think of is you're making some money from setting up and running those structures, but it's not in the client's best interest. So yeah, trusts are great.
Mhm.
They're fantastic, but what have you got? And does it make sense?
Yeah.
And there's always, that's the thing with accountants and that's the gray hairs and whatnot. It's not just crunching numbers and saving. You have to put on so many different hats. You got to be forward thinking in terms of, well, what if this happens? What if that happens? What are the legal consequences of that? Does it fit in with the client's sort of lifestyle and whatnot, how they operate? So trusts do make sense. How much money have they got at their disposal? So for you got 50K sitting there that you're ready to deploy for shares and whatnot, you're probably not at a point where it makes sense to set up a trust.
Yeah.
If you've got $1 million sitting there and you're on the highest marginal rate by far, then it probably does make sense.
Yeah.
The reason being is you can have a discretionary trust. Typically, you can do a family trust election. You can have that in place for streaming, franking credits and whatnot. Sorry, probably getting too complicated for most people out there at this point, but that's fine. It enables you to split income throughout the family group and manage the taxation. There needs to be more than tax going on. There needs to be commercial realities, asset protection things in place, but it can be a really, really useful tool from a tax minimization or tax planning perspective, 100%. Typically, like very common structure, trust, some sort of bucket company in place or low income earners. Bucket company, imagine you're generating $100,000 in passive investment income per annum. You're on the highest marginal rate, you're losing half of it to the tax man, as opposed to potentially having a trust structure in place, diverting that income to, a bucket company paying 30 cents on the dollar, where you're already upfront saving 17%.
Yeah.
That's great. 17K on 100K, compound that. But you've also got the benefit of it's sitting in a franking account. So this is a very important concept for business operators or basically people running through a company structure in general, right?
What is a franking account?
I'm going to explain that. So a franking account is effectively when you pay tax as an individual, that tax is gone once you've paid it. It's in the ATO coffers, never to be seen again. When a company pays tax, company is basically operating for the financial benefit of the shareholders, right?
Mm-hmm.
So when that company pays tax, it's effectively not paying it on behalf of the shareholders, but the end goal is to get the money out to the shareholders. So imagine that example, $100,000, you're paying 30 cents on the dollar company tax in that example, let's say. You got $70,000 cash left over after you paid your tax for the year. Now, let's say I'm the individual shareholder, sole shareholder of that company. Go, yoink, I'll take that 70K by virtue of a franked dividend. I get the $70,000 cash. I then get the tax credits, the $30,000 that the company's paid attached to that distribution. So when I do my tax return, imagining that I don't have any other forms of income, I'm taxed on $100,000. I've got $30,000 in franking credits sitting there. And then typically on $100,000, you're going to pay about $25K in tax. I now get a $5,000 tax refund. So really across the group, I'm only paying 25%. What gets even more exciting is playing around with family groups and timing. Timing's really important. So imagine, if you will, like you're one of these people, you have really high income years, low income years, high income years, right? By virtue of having that company in place and not being personal services income, and it's subject to a bunch of stuff, but it's a legitimate company, no problem. I'm able to level out tax that I'm paying over a long period of time. So let's say I make $1 million in 1 year, and then the next year I'm earning nothing, right? $1 million in my individual name, you're going to pay like $350,000, $400,000 in tax, what have you. $1 million in a company structure, it's $250,000. And then I've got the ability to pay out distributions as I see fit. So let's say year one.
You can carry that for like a long period.
Definitely. Common structure, making big money, take a bit of a distribution out. You want to keep it around that 25 to 30 cents on the dollar type thing. As you're getting older, you can start playing, and younger as well, depending on the income that you're earning. It's subject to a bunch of different things. But let's say you take $100,000 cash out, you got a $33,000 franking credit or whatever it is attached to it. You get taxed on $100K. you got $33,000 in franking credits sitting there, potentially ready to be refunded. What you might do is looking at making like a significant personal superannuation contribution, reduces your taxable income. All of a sudden, you've made a distribution where you've made a significant contribution to your super, saving for retirement. That income is getting taxed at 15 cents on the dollar, as opposed to the highest funding, quicker, better. And then you're getting a nice refund as well.
So good. We had to do that last year. But yeah, it's just like, there's just so many things that you can do. But again, like you don't know what you don't know. And I think more and more does a great job at being patient with all my questions and all my emails. But I'd love to like wrap things up. And I think we've touched on like what the high income earners typically do, what successful business owners typically do, and focusing on making high income versus how to minimize your taxes, but also the importance of tax planning.
Yes. Yeah.
And structures in place. And I'd love to ask you, this is something that I should have asked you earlier.
That's okay.
But what's something that is not on your LinkedIn profile?
Something that's not, I mean, a lot of things.
It's pretty blank.
Yeah, look, I don't really put much on LinkedIn. The way that I look at it is like we spoke about earlier, if you just focus on providing, I don't even look at it as like providing value. It's just like, what else do you do other than solve problems, right? So yeah, I don't put much on LinkedIn.
It's fair enough.
I mean, I'm into a lot of different stuff, to be honest. I mean, I've got a thirst for life for sure, but yeah, I don't know. It's almost like there's too much. I mean, I love surfing and spending time with my mates and whatnot. And yeah, I don't know. I'm going 24/7. So.
Yeah. Where is your favorite surfing spot so far?
I haven't been up there for a very long time, but there's a place called Tea Tree. It's in the Sunshine Coast. It's a mixed relationship. I actually split my head open on a rock out there, but it's got a magical feel about the place. So I love it up there. I've had some surfs up there where it's absolutely bucketing down with rain and there's like 2 other people out. You're just getting wave after wave after wave. Yeah, I love tea trees. But in terms of within Sydney, I would say Tamarama or Maroubra. We were speaking about before we started this, I'm developing a love for the North Shore as well. But yeah, maybe I'll get myself up there to live in the not so distant future, we'll say. Yeah, definitely. I mean, from the surface, I've heard that curl is nice. Yeah. Freshwater is nice for, I think, like beginner surfers as well. Yeah. No, that's amazing. And before we wrap things up, I love asking the question, like there's a new generation of like people who are working now. What advice would you give to the 20-year-olds of today? I mean, if I had it all over again, I focused on uni and just went hard out at that. And I was doing minimal work. I was working a H&R Block and I did some demolition work for a little bit. How was that? I wouldn't have survived as a tradie, put it that way. I mean, I enjoyed the culture and I met a lot of fantastic people and the job was fun. But after 6 months of demolition work, which is renowned within the trades as it's pretty full on trade, my back was giving out on me. So, but to go back to your question, it depends on what you're getting into. I'd imagine that this would apply for most professions. If I had it all over again, I would have, yes, uni is very important, but getting experience whilst you're learning helps consolidate that information, give it a real life feel. I'd say I'm like most people where, yes, obviously I learned through reading and whatnot, but learning through practice and being able to see how things are applied. I mean, 7-8 years of working 60, 70 hours a week, got there. I would have got there much faster doing uni at the same time that I was working, or doing working at the same time I was doing uni. I agree. Doing uni and working in the field that you have decided on. 100%. Yeah. 100%. And if it's not for you, you're probably going to learn. It's another thing. I see a lot of people where I don't know whether it's this generation, God, like the gray hairs, I'm starting to sound like I'm 60, but they give things a crack for 6 months at a time and they go, I hate this. You know, I've been doing accounting for 8.5 years. The first 9 months, I hated it. Yeah. I despised it. And then you get good at it and you go, this is actually really fun. Yeah, I would work on at uni and I would give things at least a year, if not 2 years to know whether and it's like anything where I feel like if you're giving your all to it and you're kind of operating with good intentions, even if it's not for you, other doors will open off the back of doing that. So yeah, just get out there and give it a red hot crack. And at least give it time, not just like a few months and you're out. Exactly. So
Awesome. Well, Ryan, thank you so much for being here. You're in Bondi
it's
Junction.
fun. Yes, exactly.
We actually have international listeners, so you can
Mhm.
visit Ryan in Bondi when you're around.
Welcome.
Thank you so much.
No problem. It's been a pleasure.
Thank you for listening to another episode of Fiery Femmes. If this resonated, share it with a woman in your life because we rise higher when we rise together. Don't forget to follow and review. It helps more women access the tools and conversations that build wealth and confidence. For more career and financial empowerment, come hang out on Instagram and YouTube at Fiery Femmes. I'll see you in the next episode.